Hey, what's going on, everybody? It is August the 1st. We're going to jump into the newest market data. I'm rocking the Work Hard, Be Kind new swag that we got, Zahnd Team Real. I'm excited to jump in this market data with you and give you the latest and greatest. So sit back, relax, and enjoy. Let's dive into it. Okay, so what happened since we last met in the macroeconomic environment? Well, on July 12th, the Bank of Canada met. They raised the interest rates a quarter point to push the key policy rate to 5%. On top of that, just a few days later, on July 18th, we got the CPI data, which is in the inflation numbers. They came in at 2.8%, which is well below expectations. There's some articles online here, and I'm going to share my screen so you can start seeing what I'm looking at here. There's some articles here that are really talking about how they were premature on raising rates. And one really interesting article right here from the Global Mail has all the different economists' view of all their different opinions. And you know what? They don't all agree. So it doesn't really matter for this what's right and what's wrong. All we need to know is that the key policy rate was pushed to 5%. Inflation data came below expectations at 2.8%. But the case for why the government is trying to, or the Bank of Canada at least, is trying to push the interest rate higher is because they're worried about something called the base effect. And let me just explain to you what the base effect is. So as you can see here, we topped inflation in the month of June at 8.1%. So we just had the June data come out at 2.8%. The reason some people are believing that inflation came in so low this month is because we were comparing it to what we call the base effect of 8.1% last year. Essentially, you're comparing the prices of today to what they were last year, and the increases in that is being measured on a year-over-year basis. So if you had super high inflation back in June of 2022, naturally, if all stays the same, the prices will come down automatically because we're comparing to a higher year. So as you can see here, after June, inflation started coming down. So our base effect is getting compared to lower inflation as new data comes out. That's why the Bank of Canada wanted to get ahead of this, raise interest rates, tighten further, because according to some data, it usually takes 2 to 4 months for the tightening of today to take effect in the future economic markets in the future. So essentially, if we're raising rates today, it's going to take about 3 months approximately to feel those effects. So what they're trying to do is get ahead of these lower inflation readings that we're going to be experiencing in the next coming months to get ahead of this so-called base effect. Is it right? Is it wrong? Well, at the end of the day, it doesn't really matter if it is right or wrong. What matters is what we can kind of see happening in the real estate market and how we can make decisions based on where we're at right now. So with all that being said, we just want to jump into some things that are happening in the macroeconomic environment where, this is essentially talking about that base effect. This article is really great. We'll link these into the descriptions below on the YouTube video about all the different opinions that are going on. And one thing that's extremely important to see here is that with all this stuff happening, and I'll just read something right here, warn investors that this will throttle home sales. So what will throttle home sales? Well, essentially, the bond yield has gone up to almost 4%. And what they're saying attributed to this is because the Bank of Canada is kicking into a tightening gear. So because of the Bank of Canada raising rates, it's pushing the bond yields up, as well as we had stronger than expected economic data, like GDP growth for the country was stronger than expected. So therefore, that's also pushing up the bond yields, okay? This is what's happening in this article here is what they're explaining. And because of that, because the bond yields are increasing, which is going to increase borrowing costs on the 5-year fixed, it's like throwing a wet blanket on the real estate market right now. In our last report, we talked about that exactly and how Q3, we're going to see a softer real estate market because we had 2 interest rate hikes. Inflation did come down below expectations, but because of the stronger economic growth and the two hikes, push the bond yields up, and we're seeing right now with a higher borrowing costs, the real estate market has definitely softened. So that's essentially the macroeconomic overview. So let's actually dive in and look at the data of the real estate market and how it affected it. All right, so we're going to start off with the interest rate trend. But before I start here, one thing I want to clarify from what I previously said, it does matter what's happening in the macroeconomic environment. All I'm trying to say is that we can't control it. All we can do is interpret what's happening. We have no control over the macroeconomic data. What we can do is see what's happening, see how that's going to affect the real estate market, and try to predict where it's going to land so we can make better real estate decisions, whether you're buying or selling. So that's what I'm here for. Our team is here to help clients buy and sell real estate and try to get the maximum value or the best deals possible. So as long as we can understand what's happening in the macroeconomic environment and how that affects the real estate market, it allows us to advise our clients better. So that's what I wanted to kind of say. So I want to wrap that up in a bow here. But let's now kick off with the real estate report here and how everything is getting affected. So as you can see, with the bond yields being pushed up from that data that we were just talking about, we could see that in May we were at 2.9% on the bond yield, and that had us at a 4.29% mortgage rate on the 5-year fix. In May, we had one of the strongest months in the year was in May and in June. That's when we had the lowest interest rates. Ever since then, the bond yields have been being pushed up, 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 and up. And as you can see, the spread kept getting thinner. So as the spread gets thinner between the bond yield and the actual offering in the market, rates will go up. We hit 1.09% spread here, goes up to 5.09. Here, when the bond yields went up to 3.8%, and if we were comparing that to the 5.09, the bond yields again were too close to 1%, so they got pushed up again. So as you can see, they're trying to maintain the spread. So every time the bond yields go up, interest rates will go up, which will throttle the market in a negative effect in terms of pricing. But if you're a buyer entering the market, it's going to help you. Again, I want to caveat all of this again, because I know whoever does watch my market reports will know I've been saying this for quite some time. If you're upgrading to a no home or you're swapping in the market, lower prices and softening in the real estate market doesn't really negatively affect you as much as you may think. You're going to actually experience cost savings, because if you're selling your house, there's decreased costs, because usually real estate sales is based on a percentage of sale value. So if you have a lower sale value, you're going to pay less costs there. And if you pay less costs there, you're going to also pay less HST, which is less taxes. And then on the buy side, if you're buying in a softer market, you're going to be saving on land transfer taxes and other costs associated with buying real estate. So in a softening market, it's not necessarily a bad thing to be swapping real estate. The people that get affected the most and that have to be the most careful are the people entering the market for the first time, or people that are looking at picking up investment assets. The other market that's got to be careful is sellers looking to exit the market completely. Obviously, if you're a buyer trying to enter the market for the first time or trying to buy an asset for your investment portfolio, you want to be buying when the market's a little bit softer so you can get in on the buy the dip opportunity. If you're a seller looking to exit the market, you're going to try to time the market a little bit so you can get the max value for that. So there's different strategies. If I was a buyer right now, I think it'd be a great opportunity that's just entering the market, because there's a buy the dip opportunity from where we were at the highs of this year. And if we're looking at selling, I think that the best time to be selling would likely be in a Q4, October, September market, when we've had another economic data release. For example, the Bank of Canada is going to meet again on September 6th. So you want to mark that date in your calendar, because they're going to be talking about raising interest rates. On top of that, we're also going to get 2 more inflation reports that hopefully are going to be stabilized. And then if the Bank of Canada holds, which is what I'm thinking they're going to do, they're going to hold rates. And then if we get some really positive economic data with inflation, we're going to see a stronger market for you to sell your assets to exit the market. Again, that doesn't really apply to you if you're swapping in the market. At the end of the day, the best thing to do is to call us, and we can advise you on all of this amazing information so you can make the best decision. All right, so just back to the report here. Sorry, I went down a little rabbit hole there, but I hope you found that useful and you followed me along and were able to make the best of that. All right, so as you can see here, interest rates are being pushed up by the bond yields. We've had steady increases over the last 4 months. If we take a look at what's on the market here, just checking that you can see my screen here, we're sitting about 260 units on the where our 5-year average should be around 260 units. And as you can see, our current inventory is around 246. So we've actually quite nicely caught up to our 5-year average in terms of inventory. We have 22 homes conditionally for sale right now, so under contract. And that means there's a net inventory. If all those deals go through, there's only a net inventory of 224. You can see that all the asset classes are catching up to their 5-year averages. The single family detached market has the least inventory compared to our 5-year averages. So this is probably going to be where you have a little bit more competition, because there's not quite as much inventory. Another interesting note here, as you can see, this is when essentially we had the worst time in the market last year, where if you were looking at selling your home and exiting the market altogether, you probably had the hardest time, because prices were dropping the most significantly at this time. But as you can see, the inventory has really stayed low here because we had that really big buying activity in the second quarter. But as you can see, as we enter Q3, which is what we were talking about last market report, the inventory is increasing. And I'll show you why the inventory is increasing towards our 5-year average. And it's not because we're getting so many listings. It's quite the opposite of that. We're getting actually average listings coming to the market with just suppressed sales. And here we're going to get into that right now. As you can see here, we've had our 5-year average is around 277 homes coming to market. We had 266 homes come to market, so we actually were right around our 5-year average, only down 3.9%, and we had 8.6 homes coming to the market every single day. If we look at the whole year in total, we've had almost 2,400 homes. Sorry, we had 1,700 homes on the dot come to the market this year. Our 5-year average is 2,100 homes have come to the market by this time usually. So our actually listing inflow is down 20%, which is quite substantial. On our outflow side, which is our sold listings, we sold 158 units in the month of July, and our 5-year average is 211. We're a whopping 25% below our unit sale average and only selling about 5.1 homes a day. Well, that should technically mean we have almost 3 homes a day in excess inventory, but there's an actual another stat that you need to know, which is failed sales. So homes that are coming off the market. Okay, and if we look at the annualized basis on this, there's only 1,154 homes that have sold in this market. We typically have around 1,500 sales by this time. So the sold market's actually down 21% as well. So as you can see, with the inflow down 19 and the sales down 21, it's actually pretty balanced. Like, I mean, there's just almost as much less inventory as there is less sold. So it's funny how it's kind of balancing itself out right now. Okay, so taking a look at our failed sales, so how many homes are failing to sell, we've actually had a really great market so far in terms of homes not really failing to sell a lot. This is definitely the highest month we've had in quite some time. We had 95 homes fail to sell, and that is exactly in line with our 5-year average. I'm not sure if you saw this or noticed this, but you can see that July and August are some of the slowest months in terms of homes coming to the market. So 277, 235. So those are quite lower than the spring months, and then obviously coming into the new fall market, which is September. And our failed and our sold listings actually, you know, our 5-year average is 6.8 homes selling a day, and we're at 5.1. It's still down 25%, but again, July usually isn't the strongest market, which is then a great market to be swapping in if there's excess inventory on the market. Okay. Okay, so how does this all stack together, and where's the monthly average sale price? This is what usually everyone wants to know. So here we are at the monthly average sale price. We are sitting at $828,000. So if you didn't know this, on my mid-month report, this all went all the way down to $780,000. So we actually recovered on the second half of the month, and we're now sitting at $828,000 on an average sale price. That's definitely down from our peak of $882,000, which was May, which was our strongest, our highest point of 2023 so far. But still, we're still significantly higher than what we started in the year when we started around 720. Around November, December, January, I was talking about how it was a great buying opportunity because we had stable inventory, stable interest rates were happening, and I said that anytime we have some kind of good news coming out, which is steady inflation going down and the Bank of Canada holding interest rates, in Q2 that really sparked a lot of buying. And if you did buy in Q2, right before it sparked up, you had a great opportunity to gain some equity, and you're still holding quite significantly well of that equity you may have gained if you bought kind of in that January, November, December market. Okay, so I was expecting this to continue to be around the $800,000 mark for the rest of the quarter here. And I do believe with some positive reports coming out that we're going to see an increase in the average sale price again around the September, October area. So if you're thinking about selling, that could be a good time for us to get a strategy together for you. Make sure your house is going to get prepared for market. So when you do sell, you're ready to go, you're ready to pull the trigger and take advantage of the market when the time is right. Okay, so when we look at the quarterly data, as you can see here, nothing really has changed. It's been increasing, and now that slight decrease, we've only have 1 month of data here, so it's going to be interesting to see what happens this month of August and see if we're going to be stabilizing around that $825,000 average sale price. So the quarterly data is still good. Funny note here that we're actually up 7% from Q3 last year. I know there's it's only 1 month of data, but we're already making gains year over year from the market we were in last year. I know obviously if you bought in Q1, it's down 22% if you bought in Q1 of 2022. But if you were buying in Q3, you're actually up almost 7% already on a year over year basis. So, there was really only 2 quarters where you kind of made a mistake in the real estate market. Otherwise, you're looking pretty positive. Monthly days on market. We could see that the average days on market creeped up to 19 days on market. So the market is definitely slowing down in terms of people aren't gobbling up the inventory as fast. On a quarterly basis, we can see that Q2 is 16 and now we're up to 19. So another indicator that it's slightly slowing down. So the average sale price is coming down, days on market's going up, but the list price to sale price ratio is holding pretty steady for now. Just down slightly to 100% list price to sale price ratio. So still actually a pretty decent market. It's just softened a bit. It's not crashing. It's not, going through the floor, and it's not skyrocketing either. It's staying pretty nice and stable, which is actually a really good market to be in, to be shopping in, to be selling in. You're not getting the highest price possible right now, but that's really only if you're trying to exit the marketplace that you need to get the most value, because if you're swapping, again, you're swapping within the same market, you're usually probably going to get the same increase or decrease on the asset you're purchasing next. Okay. Quarterly list price to sale price. And here's the inventory flow report. I'm going to zoom out a little bit, and this is just the overall summary of what's going on, and it just shows us a visual of how we're looking in the year. So as you can see here, failed sales have remained low, and they're just slightly creeping up here, which is just an indicator of the market softening. We see that the inventory, we had an excess of inventory in February, but it's been suppressed as we had that buying volume in Q2, and now we're in August. We're almost right at the 5-year average, so we're now restacking our inventory because of the softness. And our sales are pretty stable, just slightly down in July here, again because of the softening in the purchasing. Overall, year over year, based on our 5-year average, like I said earlier, we're 20% down on our amount of units coming into the market, but we're 21% down in sales, so it's almost washing itself out. And we've had 465 units fail to sell. So really, we've only added 81 homes to the market overall, right? So right now, today, there's 81 homes on the market extra than we used to have after we had the inflow minus the outflow minus the failed sales. So we are adding inventory, which is good. It's nice to have some balance in the market and have a stable inventory closer to our 5-year average. So that's a positive in my opinion. And in terms for months of absorption to kind of see if we're in a seller's market or buyer market, well, here's the analysis on that. Currently, we have 246 homes on the market. If we continue to get 8.6 homes to the market a day, we should be sitting around an extra 257. So there'll be about 503 homes to consume in the next 30 days, with sold rates being around 5.1 homes a day. So if no new homes came to the market and we had to buy all those 503 homes, how long would it take to absorb all the inventory in the market? Well, it would take about 2.3 months, which is considered a balanced market, trending a bit towards a buyer's market right now. But overall, the market isn't crashing. It isn't skyrocketing. I definitely think there's going to be more listings coming to the market, as some unfortunate buyers might be getting squeezed with the variable rate interest rate that they took on, and maybe are having some affordability issues. So we could potentially see some more listings come in the market. And if we do get that little bit of a push of extra listings, that might further soften prices for those buyers looking to enter the market. So could be a good opportunity for you guys in this quarter. If you have any questions, I hope you found this information useful. If you have any questions, you can always feel to reach out to the Zahnd team. We're happy to help you, walk you through a strategy. And here, work hard, be kind. I hope you enjoyed the market update. Please give it a share if you've found value in it. And thanks so much. We'll talk to you soon.